Good afternoon. Thank you for joining us once again at Digital Look TV in London. With us today is Ishaq Siddiqi. He is market strategist at ETXCapital. Ishaq, good to see you again.
Thank you.
Also with us is Craig Erlam. He is market analyst at Alpari UK. Craig, thank you very much for joining us again.
Thanks for having me.
Okay, gentlemen. The markets a couple of weeks ago, perhaps they were more or less becalmed. The S&P was hitting new highs. And in just a couple of weeks, we've seen quite a bit of market volatility. All of a sudden, everybody is talking about a multitude of risk factors that could affect equities. In particular, in the last couple of days, we have had a small geopolitical flare-up in Syria, in the Middle East, and people at one point were even more scared. That has subsided a little bit, but not too much. So let's try and analyze all the different factors that might affect capital markets in the next couple of weeks. On Monday, Mohamed El-Erian from PIMCO wrote an article on the FT. He cited at least 5 different factors which could affect markets. Amongst these, the debt ceiling in the US, the Fed tapering, political instability in the Middle East or the threat of war in Syria, Eurozone, the political noise, negative political noises coming out of there, and then finally, in Japan, the missing third arrow of structural reforms. Of all of these factors, above all, how serious of a threat do you see these factors for markets, and which factor is the most dangerous one, if any?
All 5 are credible downside risks for the market that investors should take into account. Certain ones should take precedence over the others. I think that the narrative has been set for Fed tapering, and that's the market's biggest concern right now.
All right.
And once we start seeing the Fed initiating the first round of tapering, that should, I think it's priced into equities at least as an asset class. After that, we might start seeing a bit of normalization and a focus back into fundamentals. But that doesn't go away from the fact that we are seeing the imbalances in the global economy, particularly when it comes to the crisis in the Middle East, Egypt, and now in this particular case, Syria, and what's been going on with these geopolitical concerns, and a possible strike by the Western alliances against Syria. And at the same time, although the Eurozone has posted growth for the second quarter,
yes,
I believe it's likely to stagnate, and political instability is on board for a little while longer, as the situation still remains quite fragile in Portugal and also for the likes of Spain and Greece. The US debt ceiling is going to be another issue that we'll be tackling in 2 months' time. I think that Congress remains deeply polarized in the US. For that reason, there's more initiative to continue kicking the can down the road and not tackle it yet, because there's no unification on board on Congress until we start seeing more reconciliation by and President Obama actually successfully forging bipartisan ties with fellow lawmakers from the Republican side. I don't think the US Congress has it in them to actually tackle the debt ceiling issue just yet, and they may possibly extend it to 2014 before they really tackle it. And they've got reason to do that. The US economy is resurging, is posting good growth on most facets of the economy.
2.5% recently.
Yeah, today we had GDP revised higher for the second quarter. So there's good news coming out from the US, and I think politicians can breathe a bit of a sigh of relief when it comes to their policies, and they can tackle it at a point when they feel that it's right to actually start addressing this.
Okay. Do you concur with those views?
Yeah, I mean, I think you've got to. I mean, there is obviously, like I say, there's a lot of risks to the global economy, really. I think things like the debt ceiling isn't necessarily one of the biggest risks, just because, like Ishaq said, all we're going to see negotiations for the next 2 months. And I'm not even sure how much the markets are necessarily going to pay attention to this. We've seen it so many times before that people have become numb to these ongoing negotiations. We've already started at a bad point with the Republicans saying they want big spending cuts, and Obama's come out and said we want no spending cuts, we just want to raise the debt ceiling. So we've not really started off on a good point here, but all we're going to see is negotiations for the next few months, and then there'll come to some kind of agreement and, like you say, kick the can down the road, and in 6 months' time we'll be talking about this again. But I don't necessarily see it as necessarily too big a threat to the markets. Same with Japan, there is potential issues to come down the road with that third arrow, the structural reforms. But we're seeing positive signs out of Japan right now. We're seeing a little bit of growth, we're seeing little bits of inflation. So the early signs are that this Abenomics is actually working, at least in the short term. And as long as they carry out these structural reforms intelligently, one of the concerns is the spending tax, which could potentially derail it. But then they're trying to offset that with a reduction in corporation tax. So immediately, I don't necessarily see that too much of a threat. It could progress negatively over the next 6 months or so and become more of an issue. But right now, I don't see it as necessarily too much of a threat. The Middle East situation is, of course, the most immediate threat, and that's what we're really seeing shake up the markets right now. But again, I'm not necessarily sure how long that's going to play out. I think it's almost just going to be, there's going to be a lot of talk over the next few months. It's almost going to be like a Cold War scenario where we're going to see the US threatening Syria, we're going to see Syria threatening the US, we're going to see the Russians have the say. We've heard from Iran threatening Israel if the US have a military strikes in Syria. So I think there's going to be a lot of talk. I think people really panicked earlier on this week at the potential of a military strike, even at the later part of this week. And I think what we've seen today especially is that there's no support for such actions without hard evidence. We've seen a lack of support in Parliament in the UK as well as among the public, and we think we're seeing a lack of support really in the US to an extent as well. And until we see hard evidence that it's the Assad regime that's unleashed these chemical weapons on its own people, then I think we're just going to see this kind of paralysis. We're going to see no real continuation, no real threat of actual strikes in the short term. So while that is what's shaking up the markets right now, I'm not necessarily seeing that as a too big a threat further down the road. I think the Eurozone, again, is obviously always a threat. But again, with German elections in September, I think Angela Merkel's been very careful to make sure that nothing really disrupts this in the months leading up to it. And again, I think the situation is calmed down a lot. We are talking about 11 billion euro shortfall in Greece's finances, but I think that is just going to be sorted later on this year. I can't really see any more. Again, it's another story that people are getting a little bit bored with, and when people get bored in the markets, you saw earlier on this year with Portugal, the political instability that we had there, and the story disappeared over the course of a weekend because it was just old news. It was just the same old story. Same with Cyprus earlier this year, that had potential to really derail the markets. And I think I speak to people nowadays and they have no idea what the latest situation is on there because, again, they've just got bored, they've moved on. I think the biggest threat in the markets right now, and even this I don't necessarily see as too big a threat, is the Fed. It's tapering. It's whether we'll see tapering in September, it's December, how much they're going to taper by. What is it that's going to start the tapering off? I mean, we have seen an improvement in the economic data, but is it really an improvement that's going to last? Is it sustainable? And I'm not necessarily convinced at this stage. Yes, we saw GDP revised to 2.5% today, but how many times in the past have we seen a 0.5% at a percentage point revised off GDP in the next two readings? So we can look at the positive points now, but I think the unemployment rate is one thing that the Fed's really looking at, and a lot of the improvement in the unemployment rates come from people in part-time work rather than full-time work, people in temporary work, which is very fragile. It means that as soon as they see an economic downturn, the unemployment rate is going to jump with these people then being quickly laid off. And then there's the participation rate, which I think is the biggest issue with a lot. If people are losing faith in the jobs market and not applying, that's just as big a problem as the unemployment rate. If anything, it shows that the unemployment rate can't really be trusted because it doesn't give an accurate picture of the amount of people who are actually unemployed. Just because they're not claiming benefits, it doesn't mean that there's not hardship. It doesn't mean that the country isn't struggling. But once that participation rate picks up again, once the economy does start to perform well, then the unemployment rate will naturally rise with it. So I think that's going to be the biggest threat. It's going to be whether the Fed tapers and whether they can justify tapering in September, which I don't think they will. I think it's going to be December at the very earliest before they can justify it, and then it's going to be how they approach it, whether they're very careful and start with 10 billion tapering and move on from there, because the markets are really, like you said, they've priced in a certain amount of it right now, but I think there's still plenty of opportunity for the Fed to cause major disruptions in the markets.
Do either of you gentlemen think that there could be or that there is a risk of a sell-off in U.S. Treasuries? Without exaggerating, but sufficient to cause a ruckus.
I think there is a potential. There is a potential for a risk of a massive sell-off in U.S. Treasuries based on that. But I think the immediate concern for the market is what sort of downside we're looking for on equities, less so on treasuries. I know that there's many global banks out there who reckon the 10-year in the US 10-year is going to reach around 3.7%.
Yes, I've seen that as well.
Was it Goldman Sachs who?
Goldman Sachs was the first. Yes.
Yeah, and it's a massive fear in the market that we are starting to see these unwarranted spikes in yields and yields and what sort of if it filters into the global economy, what are we looking at, and can this actually derail the recovery that we're seeing in the US, and is it going to force the Fed to start adjusting their policies, perhaps even hold off from unwinding quantitative easing just as of yet?
Okay.
But with the people that we talk to, the real concern now is what sort of impact is this going to do on their asset portfolios, less so on the bond side of things, but on the equity side of things.
All right.
And I think, interestingly, what we've seen is it's not so much of a fear in the market that the Fed is going to taper. The genie's out the bottle. We know that the Fed is going to taper. As Craig said, it's more so on what date they decide to taper. But what we're seeing and what we're hearing is how people are actually just adjusting their portfolio to get ahead of the Fed. To second guess the Fed's move just so they don't get caught on the bad side of tapering.
And
so
how are they doing this?
Dumping everything that isn't yielding what the developed market equities are yielding right now. So you'd rather play your growth-focused assets at the moment, pile into US equities, pile into European large-cap European equities with huge exposure to the US market, and get rid of fixed income, get rid of your bonds, get rid of gold. Although gold has seen a bit of respite in the last 2 days, given the fact that it's gained some of that safe haven demand back due to these worries of Syria, this intervention in Syria. In general, I mean, I don't see an attractive outlook for gold in any way, so long as the US economy starts to show that it's on a path of sustainable recovery. I think stock investors are playing the US growth card. They will continue playing this growth card. And after tapering, after the first bout of tapering, which I suspect will be somewhere around about $10 billion to $15 billion, we should see a normalization back in the market with increased capital flows going into the US market and a massive repatriation back to the US dollar. I think the US dollar is a standout winner this year for the FX space.
I'm going to throw you a small curveball.
Sure.
US equities, specific names?
Yeah, so US equities, I think I'm really bullish on logistic firms, FedEx, UPS. I think banks are going to benefit very, very much so by the recovery in the housing market. We've seen that. I mean, bank earnings, investment bank earnings were stellar from the US anyway, from Morgan Stanley, Goldman Sachs. JP Morgan also hinted that the US housing recovery has aided it greatly. Wells Fargo at the same time. The consumer sector in the US, companies like Sears, Walmart, the big pickup in consumer confidence in the US is aiding the recovery on that side. More importantly, more than anything else, the car makers in the US have benefited massively on the back of this recovery. The booming housing market, the fact that the construction market now is starting to show signs of recovery.
Indeed.
We are starting to see car makers, Chrysler and GM now reporting a pickup in truck sales. And at the same time, when you've got the car sector now in the US starting to show growth, you have a massive European car industry, mostly based in Germany, and have huge exposure to the US market. So you've got the likes of Volkswagen, Audi, and BMW also reporting strong sales in the US. So large cap US equities, we see a lot of...
large cap technology as well? Yeah.
Technology is an interesting one right now because it's going through a bit of a... Technology is slowing down right now in the US. There's too much, it's too saturated, there's too much competition out there. Companies are now starting to streamline their businesses. The expectations were way too high for a lot of the US tech companies, and they haven't been able to meet that. The likes of BlackBerry now, who are recently having to do a strategic review, so now they're looking to sell off part of their business. Apple, although it did report sales better than expected in the second quarter, its pipeline is pretty dim. Investors aren't really too sure where they want to be with Apple. Yahoo is an interesting story because they've recently just purchased Tumblr in order to stave off, in order to fight competition.
I've heard some very good things about this whole transaction and the long-term prospects.
Yeah, but again, Yahoo, I mean, it's a great company in the sense that it still has its amazing e-commerce arm, and it also has in terms of Yahoo Finance and its ad spending, it's still a big market player. But at the same time, when you compare it to the likes of what Microsoft are doing, it's still getting killed in the market, and Facebook as well. There's enough competition in the tech space right now that makes it, I don't think investors really know where to go with the US tech story at the moment. Microsoft will be an interesting one, given the fact that Steve Ballmer has just given his intentions to resign within the next 12 months. And I think that's a stock. I mean, I know Microsoft reported sales, 20% drop in sales for PC, for their PC division. And at this point right now, there needs to be a big change in strategy at the top of Microsoft before investors get a lot more confident, not only on Microsoft, but on the wider tech sector. So, I mean, we're not too bullish on the whole tech story at the moment right now. It's more so your real traditional cyclical players, your constructions, your industrial banks, and the housing players out in the US. That's where we see most of the interest.
So people rotating into US equities. So let's rotate a little bit around the world towards the United Kingdom.